Your retirement account just became part of the biggest financial experiment in human history, and you don't even know it yet. For 75 years, there was one rule in global finance. If you wanted to do business anywhere in the world, you needed dollars. Not because America was the strongest, because there was literally no alternative. Every oil trade, every international payment, every cross-border transaction ran through American banks and the dollar system. That forced dependency made America untouchable, but that just ended. On January 1st, 2026, China flipped the switch on a digital yuan infrastructure so sophisticated, so efficient, that countries can now bypass the dollar system entirely. And they're doing it right now. $2.3 trillion in transactions already processing. Real businesses, real trade, real alternatives. The mathematics that held America's entire financial system together just became optional. Everything you've saved is now sitting inside a system losing its monopoly, and the world just figured it out before you did. Most people think America's debt problem is visible. You see it on the news, $38.4 trillion in national debt. Politicians argue about it. The number gets bigger every year. But here's what nobody tells you, that $38.4 trillion is only the beginning of the story. It's like looking at your credit card balance while completely ignoring your mortgage, your car loan, your student debt, and every promise you made to pay for your kids' college education. The visible debt is just the tip of something far larger lurking beneath the surface. As of January 7th, 2026, the gross national debt sits at $38.43 trillion. That's money America already borrowed. That's real. That's documented. But America didn't just borrow money. America made promises. Massive promises that don't show up in the official debt number, but absolutely show up in your future taxes. Medicare alone has an unfunded obligation of approximately $52.8 trillion over the next 75 years. Social Security adds another $25 trillion. Federal employee and veteran benefits add another $15 trillion. When researchers calculate the complete picture, including unfunded liabilities to future generations, the federal fiscal imbalance reaches $162.7 trillion, add state and local government debt, and you're staring at over $200 trillion in total obligations. That's roughly $250 trillion in total liabilities, when measured properly across all levels of government. This isn't debt anymore. This is a ticking interest bomb. Here's why this matters more than you think. America doesn't have a debt problem. America has a financing problem. The difference is critical. A debt problem means you borrowed too much money. A financing problem means you can't afford to pay the interest, and you can't refinance it at reasonable rates anymore. Right now, America pays $981 billion in interest on the national debt over the last 12 months. 5 years ago, in October 2020, the U.S. paid $345 billion in interest. That's nearly tripled in just 5 years. Why? Because interest rates went up. The average interest rate on total marketable debt reached 3.362% today, compared to 1.552% 5 years ago. Every time interest rates go up by just 1 percentage point, America has to find an extra $380 billion every single year just to pay interest. America now spends more on interest than on national defense. Let that sink in. Every dollar that goes to paying interest is a dollar that doesn't go to infrastructure, research, education, or protecting the country. It just vanishes. Think of it this way. If you have a $500,000 mortgage at 3%, you pay $15,000 in interest annually. Here's where it gets genuinely frightening. America doesn't just pay interest on existing debt. America has to constantly roll over maturing bonds. Every single week, billions in Treasury bonds mature. The U.S. Treasury has to sell new bonds to pay off the old bonds. It's like paying off one credit card with another credit card, except it only works if someone is willing to buy the new card. For decades, this was automatic. Foreign central banks, particularly China and Japan, needed dollars for international trade, so they bought Treasury bonds. American investors wanted safe assets, so they bought Treasury bonds. Pension funds had legal requirements to hold government bonds. The system was self-reinforcing. Demand was endless. Supply could always find buyers. The math worked because the incentives aligned perfectly. Everyone needed dollars. Everyone needed treasuries. Lending to America was the safest bet in the world. But that alignment is breaking. And it's breaking right now. Japan and China are still big holders, but they're buying less, and that's the warning. As countries trade directly in digital yuan through the new payment infrastructure, they need fewer dollar reserves. Smaller reserves mean less treasury buying. Less buying means the U.S. has to find new buyers. This is where the mathematics becomes dangerous. The U.S. Treasury issues roughly $400 to $500 billion in new bonds every single month just to roll over maturing debt. That's not new borrowing. That's just refinancing existing obligations. But what happens when demand starts drying up? None of them are good. Choice 1. Offer higher interest rates. If demand drops, the only way to attract buyers is to pay them more. You raise yields, you make treasury bonds more expensive to service. Remember that $38.4 trillion debt? At 5%, it costs $1.92 trillion per year. At 6%, it's $2,304 trillion per year. That's more than the entire defense budget, more than Medicare. You're not borrowing more money, you're just paying exponentially more to borrow the same amount. Choice 2. The Federal Reserve buys the bonds. If private buyers won't step up, the Fed can print money and buy treasuries directly. That's quantitative easing. That's how the Fed responded in 2008, 2011, and 2020. But every time the Fed prints money and buys bonds, the real value of the dollar decreases. Inflation rises, your purchasing power falls. It's a slow tax on everyone holding dollars. Choice 3, default or restructure. America will never technically default because it can print dollars. But restructuring means paying bondholders less than promised. That destroys confidence in U.S. debt and triggers a cascade that's nearly impossible to stop. And here's the death spiral. Higher interest rates make the debt more expensive to service. More expensive debt means larger deficits. Larger deficits require more borrowing. More borrowing means more bond supply. More supply with questionable demand means higher interest rates again. This is the confidence leak. Once it starts, it's incredibly hard to stop without dramatic fiscal reform. America can't even agree on a basic budget, let alone generational fiscal restructuring, which means the debt keeps growing, which means the interest burden keeps rising, which means the financing problem gets progressively worse with every passing month. The refinancing wall is coming, not next month, but within the next 3 to 5 years. As more bonds mature and fewer foreign buyers show up, the mathematics becomes undeniable. That's when the market starts pricing in real risk. That's when interest rates spike. That's when everything changes. This is the mechanism most people completely miss. The digital yuan doesn't need to become the world's reserve currency to change everything. It just needs to make using dollars optional in ways that didn't exist before, and that's exactly what's happening right now. As of the end of November 2025, China recorded 3.48 billion cumulative digital yuan transactions worth 16.7 trillion yuan, approximately $2.37 trillion US. That number grew 800% in just 2 years. More importantly, China engineered the digital yuan with interest-bearing features, combined with stablecoin-like functionality while keeping it sovereign and regulated. This makes it extremely attractive for commercial transactions. It's not some experimental cryptocurrency. It's a government-backed digital currency with real utility. China is now testing the digital yuan in cross-border use across border regions and tourism-oriented economies: Hong Kong, Macau, Laos, Thailand, Cambodia, and Singapore. Each connection creates another pathway for trade settlement that doesn't touch the dollar system. Each pathway represents reduced friction, lower costs, and faster transactions compared to traditional dollar-based settlement. Imagine you're running a business in Thailand. You trade heavily with China. Previously, every transaction required converting to dollars, paying currency conversion fees, waiting for settlement through American banks, and taking exchange rate risk twice, once going into dollars, once coming out. The entire process took days. The entire process created demand for U.S. Treasury bonds because Thailand needed to hold dollar reserves. Now you settle directly in digital yuan. Instant, cheaper, no dollar needed. You don't stop using dollars for everything else in your business. But for that one trade relationship, you just bypassed the entire dollar system. You eliminated the friction. You eliminated the cost. You eliminated the need to hold dollar reserves. Multiply that by millions of companies across dozens of countries, and suddenly the daily demand for dollars drops. Not dramatically, but consistently. Every single day, a little less dollar demand. Every single week, a little less treasury buying pressure. Every single month, the foundation gets slightly weaker. This is the bypass, not replacement, not destruction. Reduction. Project mBridge, the platform processing these transactions, now handles over 95% of its total settlement volume in digital yuan. The platform processed over 4,000 transactions involving China, Hong Kong, Thailand, United Arab Emirates, and Saudi Arabia, all trading directly in their own currencies. Think about what that means. Saudi Arabia, America's oldest Middle Eastern ally, actively participating in a Chinese-led payment system. They're not doing this to hurt America. They're doing this because it's objectively better technology, faster, cheaper, more efficient. The network effects compound relentlessly. More usage means better infrastructure. Better infrastructure means easier adoption. Easier adoption means more countries join. More countries joining means less dollar dependency across the board. And less dollar dependency means less treasury demand. Less treasury demand means higher interest rates. Higher interest rates on $38.4 trillion in debt means the mathematics accelerates toward breaking. Here's what makes this fundamentally different from previous predictions of dollar decline. For the first time in modern history, there's credible alternative infrastructure for international settlement that actually works. Not conceptually, not theoretically, actually built, actually functioning, actually processing billions of real transactions with real businesses and real trade happening right now. By the end of November 2025, China had processed more than 3.4 billion transactions worth roughly $2.3 trillion. That's real businesses choosing alternatives to the dollar system because it makes economic sense. The technology exists and works. The network is growing month by month. The incentives align perfectly for participating countries. And the mathematics behind America's debt load gets worse every single month. Those four factors haven't been true simultaneously in modern history. That's why this time is fundamentally different. The bypass isn't theoretical anymore. It's operational. It's scaling. And it's just getting started. This is where everything becomes genuinely dangerous. Markets don't price risk in straight lines. They price it exponentially. Right now, U.S. Treasury bonds are considered the safest asset in the world. The risk-free rate, the foundation of all financial modeling. Every pension fund, every insurance company, every institutional investor prices everything else relative to Treasury yields. That mathematical certainty has held for 75 years, but certainty is evaporating. The yield on the 10-year Treasury note finished at 4.24% on January 16, 2026. The 30-year note ended at 4.83%. Those numbers are rising not because of Federal Reserve policy changes, but because of something far more dangerous, risk premium. Investors are starting to question whether America can actually service this debt long term, not default. America will never technically default because it can print dollars. But what about the real value of those dollars? What about the purchasing power of the bonds when they mature? What about inflation erosion? When confidence starts to leak, and it always starts small, interest rates rise. Not because central banks raise them, but because investors demand higher yields to compensate for uncertainty. A few basis points here, a few basis points there, invisible to most people, but exponentially dangerous to the system. Here's the mechanism. Higher interest rates make the debt more expensive to service. More expensive debt creates larger deficits. Larger deficits require more borrowing. More borrowing means more Treasury supply hitting the market. More supply with questionable demand means rates rise again. This feedback loop is the death spiral. Once it starts, it cascades with terrifying speed. Look at what happened in Europe during the sovereign debt crisis. Countries like Greece, Spain, and Italy saw borrowing costs spike not because their economies collapsed overnight, but because investors started questioning sustainability. Once that questioning begins, it spreads. Other countries face higher rates. Higher rates worsen their fiscal positions. Contagion accelerates. Within months, what seemed manageable becomes a crisis. America has advantages Europe didn't have. The dollar is still the world's reserve currency for now. America can print its own currency. The U.S. military is unmatched. These are real advantages. But advantages aren't immunity. Advantages just mean the timeline stretches out. They don't prevent the eventual reckoning. Right now, net interest as a share of federal outlays is forecast by the Congressional Budget Office to be 13.85% in fiscal year 2026, 14.11% in fiscal year 2027, and 14.52% in fiscal year 2028. Watch those numbers. If they accelerate faster than projected, you're watching the confidence leak in real time. If Treasury auctions start showing weak bid-to-cover ratios, if the government starts having difficulty selling bonds at reasonable rates, that's your warning signal that the market is repricing risk. The collapse isn't coming in some future dramatic moment. It's not a single day where everything breaks. It's not a crash you'll see on cable news with a red crisis banner. The collapse is already here. It just moves so slowly that most people won't realize it's happening until they look back in 5 years and wonder when everything changed. Here's what you need to understand. This isn't about panic. This isn't about selling everything and hiding in gold. This is about recognizing that the financial system that created your retirement account, that defined your career, that shaped every economic decision for the past 75 years, that system is fundamentally changing. The certainties are becoming uncertainties. The safe assets are becoming questionable. The mathematics that worked for generations is becoming the mathematics that doesn't work anymore. You don't need to do anything dramatic today, but you need to watch. Watch the interest rate trajectory, watch the Treasury auctions, watch the digital yuan adoption across international trade. Watch the slow erosion of dollar dependency, because the moment that erosion accelerates, and it will accelerate, the ground beneath the financial system shifts permanently. The mathematics didn't break tomorrow. The mathematics broke on January 1st, 2026, when China made the digital yuan a true alternative to the dollar system. Everything after that is just the inevitable playing out of numbers that stopped adding up. Your retirement account sits in the middle of this shift. Understand it. Prepare for it. Because everything changes when the world stops needing dollars as much as it always has. And that world just arrived.